Most small business owners are carrying silent killers in their wallets. Not bad ideas, credit cards. They start as a convenience, a quick way to manage expenses. But for millions of businesses, they become the main source of working capital. And that's where growth goes to die. According to Experience 2024 data, 65% of small businesses use credit cards as their primary funding tool. Average interest rate between 18 and 22%. That means every $100,000 you carry costs $18,000 to $22,000 a year before you touch principal. That's money that could hire staff, buy equipment, or fund marketing. Let's make this real. A design agency I worked with carried $150,000 across 3 cards. Monthly payments were over $4,000, mostly interest. They were spending nearly $50,000 a year servicing debt that wasn't creating growth. We restructured that into a revenue-based financing deal at 11% cost. Same principal, half the expense, and 6 months later they had the liquidity to expand. Here's what happens with credit card funding. It masks the real problem: lack of working capital and structure. Because it's easy. You swipe first and think later. Soon you're running payroll, ad spend, and inventory on revolving credit. That's not leverage, it's dependence. The average small business holds a cash buffer of only 27 days, according to JP Morgan's 2024 report. One delayed client payment, one slow month, and you're floating expenses on plastic. Then the compounding begins, and you spend the next 12 months paying for last year's delays. You can't outwork compound interest. Here's what I tell every founder. Credit cards are for convenience, not capitalization. They're great for points, tracking, and minor expenses. They're deadly when used for growth. Growth funding should generate ROI. Debt funding should preserve operations. Credit cards do neither efficiently. So what's the alternative? Structured capital. That could be a short-term working capital loan, or crowdfunding raise, or private investor funding. Even at 10 to 12%, it's half the cost of revolving credit. Start by calculating your interest drag. Take your total revolving balance, multiply by your average APR, and divide that by monthly cash flow. If the ratio is above 10%, you're working for the bank. Now let's talk psychology. Many entrepreneurs wear debt as a temporary badge. I'll pay it off next quarter. But most never do because growth requires reinvestment. You're always one project behind on payoff. Real discipline is replacing bad debt with good capital. Here's an example. A local home service company consolidated $120,000 worth of debt into a $200,000 Reg CF raise. They used part of the proceeds to clear balances and the rest to fund marketing. In a year, sales grew approximately 35%, and their monthly cash flow doubled. Debt removed friction, capital added speed. If you're nervous about the legality or complexity of raising capital, know this. Regulation crowdfunding is fully approved by the SEC. You can raise up to $5 million from both accredited and everyday investors each year, provided you disclose financials and follow compliance rules. Platforms handle the paperwork, you handle the story. The story investors want is simple. Show them how money creates more money. Show discipline. Show transparency. Show vision tied to math. Debt is a tool. Credit cards are a trap. Tools build, traps confine. So here's your action plan. Number 1, run your numbers. Know exactly what you owe, your rates, and your minimums. Step number 2, replace expensive debt with structured capital. That could mean refinancing, raising equity, or launching a small public offering. Step 3, commit never to use credit cards for growth again. Reserve them for operational flexibility, not expansion. Financial freedom isn't just about income, it's about control of cost. Every dollar of interest is a dollar of power you've given away. Remember, banks profit when you revolve. You profit when you resolve. Get out of the cycle. Fund forward, not backwards.